Hi, it's September 24th. Good time for an update. Important time in the markets here. Over the last week, I've discussed how important this 80 and 90 year cycle conjunction is. It's hitting in late 2022. And normally that big a cycle would have a crash that starts, that goes from early 2020 into late 2022. But we know we've got all this nonstop stimulus, so they keep pushing these markets up. But one of my points is the markets are pushing against a very important timeline. Late 2022 is the most important cycle of my lifetime, okay? 1932 was big, but that was the 90-year cycle, which is the most powerful. 82 was the 40-year generation, an 80-year cycle coming together, very powerful, and that was a long-term bottom. But this is the most powerful convergence. So we should expect something big to happen here. And of course, the big issue here is since the central banks have been able to stave off this recession and a major stock crash, which it obviously has wanted to happen since, or continued to happen for many, many years since 2008. Can they cushion this? And my argument is the more you push something against cycles, the more you stretch the band, the more it comes the other way. This is 100% artificial stimulus. We have to get this. The rally since early 2009 is not fundamental demographics getting better. It has been a favorable technology cycle, but that clicked out by late 2019, early 2020. So this is going 100% on artificial. So I say the fundamentals reign here, and we have a big crash coming ahead. I've also looked recently, HYG, high yield bonds. And people also notice JNK, another ETF. It's the same thing. I'm getting people in the newsletter saying, well, what about JNK? HYG and JNK are pretty much the same type of high yield bond fund, and they act similar. So I'm just focusing on HYG. But that's been coming into a very tight, topping pattern from a rally since COVID that has not made a new high, which is a bad sign, into 88, and it's still sitting there right now. It has very little upside without breaking up, which is very unlikely, and a big downside. This is the #1 chart that's pointing towards a big correction and recession ahead. It should go down at least 50% in the next year, and maybe 60% if we extend out in 2023. And again, even though late 2022 is the big cycle target, since we pushed this a year and a half past when this top should have happened in early 2020, then we could well see a final bottom as late as late 2023 in this. So, but I still think most of the damage is going to be in late 2022. Also, most important, in the last week I've been warning you, got this wedge going up in the S&P 500, okay? And that's the way bull markets tend to end, in a narrowing wedge or a channel. Well, we broke that, early this week. And we broke down clearly below it. And just yesterday, we rallied back up near the bottom line of that wedge, okay? And that is now the resistance. Yeah, we got a new high at 45.46, but coming up very close to 4,500 here, we've got strong resistance. I don't think the market's going to break this on the upside. I have never seen a time where a wedge or a channel like this has been broken and you just go down and have a correction and then run up to new highs and break back into the channel. Now, we could go sideways for a while and make a new high. That's a possibility, but I think that's unlikely either. But of course, I'm going to be looking for that. But the most important chart I'm looking at right now, and subscribers look for an update coming soon on this if the markets start turning back down, which they have started a little bit this morning after the rally yesterday. 2,100 on the Russell 2000. That's the line in the sand. We've seen 4 tests of that pattern in the last 9 months, since January of this year. And we go down one more time, I think we're going to break that. We break 2,100. That is going to be the first clear sign that we've put in a top. Now it'll look that way to start going down, but that'll be the first time I can tell you we break that. We're going to be down to 1840 in no time by those projections, chart patterns, and then we likely keep going. And so that's the thing I'm going to be looking at the most do we break that 2100 level? Now, Bitcoin, real quick, Bitcoin has till the end of this year to make a new high. That 4-year cycle is very ironclad so far. And I tell you, it's looking really weak, especially after the Chinese said, you're illegal, man. We're banning you. Oh, now that's weakness. I mean, ultimately that's bullish for the cryptocurrencies down the road that the governments are fighting it, but governments are fighting it. And Ray Dalio warned just the last week or so, governments are going to stop this if it gets too popular. And here you see China saying no. So pretty hard for me to see Bitcoin going up to that 85,000 to 115,000 max new high. So Bitcoin has probably peaked, and that does not bode well for stocks. Bitcoin, like the dot-coms, I keep stressing, in 99 and early 2000, the last wave of that first tech bubble, the dot-coms were the accelerator. Well, the cryptos are this time. They're just not part of the NASDAQ, but they're still that same thing. So if Bitcoin is peaked, then less and less likely stocks are going to make new highs and are going to head down soon. So that's what we're looking at. Now, real quickly, on Tuesday, we had that one-day crash that was scary. And I tell you why it was scary to me. The market just could not bounce all day. The bounces were tiny. Now, what that said to me, that told me that's Robin Hood traders. And that's what we have in this rally in the last year. The biggest component of that in the latest stage were the everyday traders on E-Trade and all these trading sites and stuff are buying call options. They're buying on leverage. They're gambling. And as the market started going down on Tuesday, you keep tripping margin calls on those people. So that's what was happening on Tuesday. It was constant selling because you have a lot of small traders, but they keep getting tripped into having to sell. So there's a lot more of them to come, okay? The smart money only came in at the end of the day. So that tells me that's really one of the triggers here. So we're in this channel of the Russell 2000, and 6% would take us a new high and kind of invalidate for that for a while. I think that's very unlikely. Only a 6% downturn would take us into, this looks dangerous, this thing's over. So again, be very, very aware. I'm going to be putting out updates in the next week. And I think we are getting very, very close to a crash that is going to surprise, I think, everybody. Now we only have a little over a year to go into this very, extremely strong late 2022 cycle. Again, something I've been talking about since the 80s, that this would be the lowest point in our lifetime in stocks. And it could be extended a year now because of this. But don't think, or at least I don't think, the central banks are strong enough to beat this final cycle after they pushed it up and stretched it so long. So again, look out, and I will keep you updated.